topic for today is focused in DeFi lending protocols. So we'll evaluate the progression of the space from a very incipient space in late 2010s to early 2020s to where it's now, the current status. We'll do a deep dive of all of the data to assess the health of the industry and also the new players that have emerged. And finally, what comes next? There's a lot of exciting things that I'll get to there. But first, a quick update about Into the Block. So we continue doing progress both on our analytics and institutional DeFi products. On the analytics side, we launched Ethereum ETF's dashboard, where you can finally track all of the allocations by each ETF provider. We've also been working a lot with the TON ecosystem. So we launched support for TON, the token, and a lot of the Giaton tokens, which are like the ERC20 equivalents. So we launched a token ecosystem, a TON ecosystem, dashboard in our analytics app that's free to access. You guys can check those out today. And on our DeFi side, our risk product that we use to manage economic risks, we launched Gearbox, which is a lending product we'll get into later. And also with liquidity staking, we've been doing a very large overview of the space. So we've already launched EtherFi a few months ago. And within this week and next week, we'll be launching Swell and Kelp, which are other of the large players in the space. So keep an eye out for those. And finally, I'll also touch on this. We launched Aave for the custom instance of Lido, which is this new type of markets that Aave is doing. We have economic risk management for the Aave Lido market, 20 plus indicators. You guys can check that out for free at defirisk.intotheblock.com. All right, so let's get started with some context. For the purpose of the presentation, we'll be focusing on DeFi applications specifically for lending. So those are the ones that are non-custodial. Users are able to withdraw their funds and they're held at a contract, but not by any individual. And they're permissionless. You don't need, any one person to give you access to these platforms. So not like centralized lending companies. And we'll be focusing specifically on money markets, which is, Aave, Compound are the classic examples of that, and not that loans here are borrowing other people's funds rather than minting it. So it's not like DAI, which is another type of loan. Here you're borrowing someone else's funds in an algorithmic way. The first innovation that really allowed the DeFi lending space to grow was the transition from peer-to-peer to peer-to-pool. And this was a transition that was initially pioneered by DEXs. I believe Bancor was the first one that introduced this after a Vitalik post. Essentially, the first few DEXs were following the central limit order book model, very similar to what you see in Binance or other centralized exchanges. That being said, the throughput and latency constraints of blockchains made it not feasible for DEXs to follow that, model. And instead, it was better to work with the AMM model, where someone would deposit into the pool and the pool would just automatically rebalance instead of each person having to make decisions on how to balance their assets. That made it a lot more efficient and compatible with the nature of blockchains. And this started in 2019 with DEXs, and shortly after, Compound V1 followed a similar model with the peer-to-pool model for lending. ETHLend, which is now known as Aave, tried launching with peer-to-peer, but failed to get traction, and they rebranded to Aave and also pivoted to the peer-to-peer, peer-to-pool model, which is still the core architecture that we use now, similar to what we see here, where people just apply into a lending pool and then assets are borrowed by other people in the borrowing side. But it doesn't have to be person to person. It could be multiple people borrowing from multiple people. That sort of made the bedrock for DeFi lending protocols. and it was tested during 2018, 2019. And then as the market started getting some traction, you can see here, 2018, 2019, that TVL and DeFi surpassed 1 billion. This is from DeFi Pulse for those who remember the site. And then incentives really applied the rocket fuel to this movement. So in 2019 and 2020, we started seeing the first experimentations of liquidity mining in synthetics and in Uniswap. But really, what blew it out of proportion for the whole industry was when Compound launched their Comp token here in May 2020. And DeFi TVL more than doubled within a couple of weeks. So that's the period known as DeFi summer, where essentially people started playing around with all sorts of experimentations. Since it's all open source, it was very easy to replicate and try to make different adaptations of these protocols. And really also, for better or worse, began iterating on Ponzi-nomics, on like making incentives to attract people and capital, though that in a way has corrected. And then the next progression for the DeFi lending space was really expanding beyond Ethereum. So in 2021, we saw the launches of Polygon, Avalanche, Solana, well, at least the launch of their DeFi ecosystems. The chains had been live for a few months earlier. And so we see DeFi expand beyond Ethereum. This really kicked off in the bull market as people were very risk on and capital went to less battle tested chains. And so we see the dominance here in blue of Ethereum TVL drop from 90% to under 50% in 2022. And then start climbing back in mid to late 2022 as the market corrected, and within DeFi was sort of a flight to safety to go back to Ethereum versus other chains that were having issues, outages, etc. And nowadays we also see rotation in market share. So Polygon, that was quite relevant in 2021. Really in 2024 is not so much as it used to. Terra, which is this pink line, completely evaporated, as you guys can see and are probably familiar about. And Solana more recently has gotten a lot of tractions, as well as DL2s like Arbitrum and Base, which have a decent size of the TVL share. Now let's discuss, it does include L2s. I understand your point that Vanessa from the chat, that's part of the Ethereum, but there's also increasing debate on whether those are competitive with the L1 or not. So for purposes here, it's just Ethereum mainnet in blue. All right, so let's discuss the current status of DeFi lending protocols. So as everyone here is probably aware of, we had a pretty brutal bear market that went risk off for crypto. And DeFi, which was still very speculative, especially back on the back of 2021, had a massive contraction in the amount of lending and borrowing activity. And in 2023 and 2024, we've seen the recovery of that, primarily on Aave. So Aave used to be about 50% of the market in 2021. It's now about 70% of the market. And Compound has dropped from 30% market share to just over under 10, I believe. CeFi lending actually got an even worse hit. So Genesis, BlockFi, Celsius, all of those that had at their peak over 100 billion in loans between all of them. Genesis alone, I think, had like 80, 90 billion, if not over 100. They were not transparent, so it's very hard to make show the data. But they have gone to essentially zero as those companies went bankrupt, and there's still a couple that survived, and those have recovered. But the whole industry for CeFi lending has taken a much larger hit than DeFi lending, which all in all was pretty resilient to the market drop. You know, there were no major losses for people on these protocols. And now in 2024, we see loans in DeFi back above 10 billion. We also see the recovery in yields, so not just in the borrowing activity, but of course in lending protocols. As you borrow more, borrow rates increase. Borrow and lending rates both increase. So in bear markets, we saw for USDC 2 to 5% in rates, which were even at a point below what treasuries were paying. Now, especially also now that treasuries have been integrated in DeFi, we see like a minimum yield of 5% across the board to borrow, usually with some exceptions. And in the bull market, even though we've seen like a decay recently, and the first half of the year, we saw up to 15% yields in a couple of weeks. And that's slowed down, but you know, at a much higher low than what we saw in 2022 and early 23. And this, you know, emphasizes the cyclical demand for DeFi funding, which is usually used for speculation. So when people are very optimistic about the future and prices in crypto, they tend to borrow against it and thus drive higher yields. However, I would still argue it's mostly speculative, but there's increasing exceptions to that case. Importantly as well, DeFi lending protocols and DeFi in general are more battle tested than ever. So from a technical risk perspective, we see code being a lot more battle tested, and best practices have spread throughout the industry. Now you see any protocol with significant traction have multiple audits. Also, the longevity of that code has lasted a lot longer. Therefore, it has been battle tested further as people naturally try to exploit these contracts, and the longer they've retained TVL over time is a sign of the protocols getting more battle tested. And I would emphasize that this is reflected in the amount of exploits being down 99%. So this is a success story that is rarely talked about in the industry. But you know, you can see the trend here is quite astonishing how much DeFi losses have shrunk. And both from a technical and economic perspectives, we're seeing a lot less exploits, which are positive signs that DeFi is maturing. From an economic risk perspective, we're also seeing protocols better manage the risks that they entail. So we see specialization both at the protocol level and the LP layer. So from the protocol level, apps, platforms like Aave are better at understanding the risks of liquidations and bad debt. This is perfectly shown just a couple of weeks ago when the Japan yen carry trade was unfolding violently and the crypto space crashed. We saw over 250 million in liquidations, an all-time high for Aave, and there was zero bad debt, which is very different from what happened with CRV back in like April 2022, where a small CRV liquidation and that in also relatively small bad debt. That hasn't been the case anymore, and I think that shows that the protocols are getting more specialized. And on the LP layer, there's also increasing automation, part of it provided by Into the Block, that allows positions to automatically rebalance and avoid liquidations. So both the protocol and the LPs are getting more savvy at managing risks. And some of the risks that are still protocols to still have to deal with are increasingly isolated, as I'll get into. Another trend that's worth highlighting is USDT. Its dominance in DeFi has really accelerated in the past year. So in DeFi in 2021, it was mostly USDC that was used. They really embraced it early on and got a first mover advantage, while Tether was focused on CeFi. That is changing, and now USDT is going for USDC's throne. You can see here on the amount of USDT supplied on Aave surpassed the amount of USDC for the first time this summer, and is still slightly higher than the USDC amount. Meanwhile, DAI has lagged behind, and really decentralized stablecoins haven't panned out as much as it was one thought. Importantly as well, we see what our CEO, Jesus Rodriguez, coined as micro primitives. So this is across the board in DeFi, but you see it specifically in lending as well. So micro primitives we would define as extensible base layers of protocols that can be specialized for multiple purposes. So that creates flexibility for people and protocols to build on top of a very resilient base layer that allows more experimentation on top. That tends to lower risks for the base layer, but also creates a lot more risks on top and delegation. So even though it's not live, a great example of this is Uniswap v4, where hooks allow pool creators to adjust parameters for the pools, and those can vary based on certain conditions over time. So it really makes it for such that the pool creators get more responsibility on what the risks are and how to manage those. But ultimately creates a competition layer on top where the customer will choose like what pools work best for them, be them like an LP or a trader, and really allows more flexibility, which unlocks more use cases, albeit in a challenging environment. So I'm not sure if I would classify this as a micro primitive itself, but a good example of the first lending protocol heading on this direction of experimentation is Silo, which in 2022 launched with isolated risk markets. So Aave and Compound you can think of as one shared layer of liquidity, whereas where essentially you take the risks of all of the assets in that basket. There's risk management for each, but their their pooled model, whereas Silo pioneered the isolated model where each asset has a different pool, and therefore if you're in a pool just applying BTC and borrowing stable coins, and there's a token like ApeCoin in another pool and ApeCoin gets exploited, only depositors in the ApeCoin pool are affected, but not in the BTC pool. So it allows certain security to be able to transcend the pooled model. That being said, it fragments liquidity, which is the main challenge with this, and I believe their Silo v2 version is addressing that. Moro Blue came in to solve that issue of the fragmented liquidity with their shared liquidity model. Essentially, Moro Blue is an aggregator of liquidity across, they call them metamorpho vaults. So people supply liquidity to metamorpho vaults, and those metamorpho vaults deploy into certain markets where essentially people borrow on the other side. So the curators are in the middle, managing these metamorpho vaults, allocating capital on the behalf of the users, abstracting that complexity where people are not sure what assets to borrow against, or what collateral assets to accept rather. So it allows a competition layer at the curator level, where curators are looking at different assets and evaluating the best risk return profile for their users. And Morpho has been incentivizing the curators as well in terms of the ones that attract most liquidity, therefore helping solve that liquidity fragmentation while also having some risk isolation, depending on how curators allocate capital. Then a similar approach is being taken by Aave. In Aave v4, there will be even more isolation, but that's not coming until next year. So in the meantime, what they've opted to do is what are being called custom instances. So we've been working very closely with this. In fact, I think it was announced that we helped attract liquidity for the Aave Lido market. And this is a very specialized partnership of a market that's only for Lido and the Lido Alliance. It launched with just staked ETH collateral first, with the main use case being getting leverage staking yields. But it will also be expanding to other tokens in the Lido ecosystem, such as symbiotic restaking tokens. I believe those will be supported in the next couple of weeks. And it creates a demand to borrow ETH against those liquid restaking tokens that might have higher risks and would be potentially a risk for the general Aave market. It isolates those risks to be just in the Lido market, keeping the general Aave market as more blue chip, so to speak. Then Athena is also launching a market in the next couple of weeks, custom instance, where they'll be able to supply USD and SUSD and borrow other stablecoins against it for people that want extra yield on their essentially carry trade exposure. And more interestingly, EtherFi is launching a credit card market on top of Aave, where people will be able to supply wrapped ETH and borrow stablecoins to be used as a credit card. I'll talk about that a bit further. We're also seeing experimentation on how the lending itself happens. So usually it's dynamic rates, dynamic terms, but that has unpredictability. As I showed, rates can spike and go down. So it creates a lot of friction for more traditional entities to accept lending. So out of that challenge, Term Finance and more recently Syrup from the Maple team have been doing fixed term lending, whereby an amount of institutions select yield that they would want to borrow against. And essentially creates a clearing market where lenders and borrowers are choosing what rate makes sense on a weekly basis and set a term duration. It's typically 4 weeks, but I think it goes up to 13 weeks in the case of term. And during that duration, the yields don't vary. So if you say it's going to be a loan on USDC at 5%, it'll stay at 5%, which creates a lot more predictability. And, that creates less uncertainty for institutions that want access to credit, though at the expense of potentially sacrificing the deposits for a temporary amount of time. Then we also see Gearbox come out as a lending protocol that's specialized just for yield farming, and points farming, as that really took off in Q1 of this year. It's a highly cyclical space, but you can see that they've gotten, I think they have about 200 million in TVL, but the rates are very volatile, as it's very speculative. So you can see ETH borrow rates went from like 3% in February to 15% as points farming really took off. So you can see that the industry is evolving. DeFi protocols are getting more specialized and experimenting with different segments of use cases. Now, what comes next? What is the next step that will really help push DeFi beyond the echo chamber that we're in at the moment? So there's multiple things that can be done to really expand DeFi over the next few years. One of them, and this is a challenging one, is under collateralization. So all of the loans in DeFi are over collateralized. So why is that the case? The reason is anyone can access DeFi and just use their address. No one knows who you are in DeFi. There's potentially no ramifications, as there's very little connectivity between your on-chain address and your real-world identity. So if you were to say, no, trust me, to Aave, I can borrow 100K and provide no collateral, well, that would really likely result in losses for the protocol, as there's no ramifications for people to repay that debt. So at the individual level, identity is something that could be used to help improve, or at least create the prospects for under collateralized loans to take place. So there's some infrastructure improvements that are helping us get there. I think it'll take at least a year or two for this to really pan out. But we're seeing Coinbase come out with their Ethereum attestation service, where essentially Coinbase users can validate that they are responsible for each address, and thus tying their real-world identity with an on-chain address. And we're also seeing the advent of zero-knowledge transport layer security, CKTLS for short, which essentially allows secure plugging in of APIs into Web3, which allows for unpampered access of something like the Twitter API for you to validate that you're the owner of an address. And while that sounds very basic initially, it will allow a lot more connectivity between the Web2 identities we have in social media and other platforms to Web3. So a funny example of this was this DAO, I'm forgetting the name, gave an airdrop to holders of the GameStop stock. So as I'm forgetting this guy, the viral YouTuber came back. They did an airdrop for people holding GameStop as part of that movement. And that was the first example, Roaring Kitty. Thank you, Daniel, for joining. That was an example of the first interaction between like Web2 and Web3 services. And you can think in a not so distant future, once you connect your reputation in Web2 social media to Web3, you could potentially be using your reputation as collateral instead of capital. And I think that's where we're heading in the next few months. And on the protocol level, this is something where we've experimented at Into the Block. You can see bootstrapping against future revenue. So the way that works is essentially in looking on chain, you have a track record of the revenues of established DAOs like Aave, for instance, and you can forecast how much the revenues would be. So you can get businesses or even other DAOs lending to those DAOs to get essentially a loan that could be potentially paid out on a block-by-block basis, as revenues can get streamed back to lenders, and it creates a more efficient credit market. So it's very similar to the way mortgages work or other types of business credits work, except it's all automated and on-chain. So you can transparently track if your credit is being used correctly and if it's generating revenues, and also minimize the credit risk as the revenue can get automatically paid back. So that could work to bootstrap businesses, especially those that already have a track record, and then eventually even to individuals if they opt in to get loans against their income, for instance. The final thing, I know we're wrapping up on time. I have a couple more slides that we'll see is more real-world integrations. So PiUSD from PayPal has doubled down on DeFi. We saw it surpass 1 billion in market cap, more recently with Camino integration on Solana, reaching almost 500 million, now at 400 million in TVL. That is likely to continue to grow. We've been in some conversations with PayPal, and they still have plans to continue expanding and eventually creating a better remittance market. Biddle from BlackRock is another example that has gotten a lot of traction recently. They have over 500 million in tokenized treasuries and really worked as a stamp of approval with BlackRock getting into DeFi. So at the moment, these are basically just mirror assets where you earn the yield that you would earn in your traditional treasuries, but on chain. I think over the next year or two, we'll start seeing more experimentation beyond that, where the assets can be integrated within DeFi applications, unlocking more use cases where they're instant and permissionless, something that is completely foreign to the traditional finance system, and eventually have the settlement of these stocks and bonds to happen on chain in a more transparent way, sort of in line with what I mentioned with the bootstrapping against future revenue. Another example that I mentioned is Ethery Cash. that we're closely working with as well. They're creating an Aave market to borrow against your crypto, and that loan should be able to be transitioned into stable coins that can be spent in the real world. And they also offer lower rates than existing credit cards, since people can take the other side of that, lending capital at 12%, which is still half of the 20-30% that credit card issuers charge. And one final example that will really, in my opinion, help boost the industry in the long term is Apple Pay integration. So a month or so ago, Apple Pay announced that they're opening up to third-party integrations. Before, it was just very safeguarded approach. And it really got me thinking of the way that we use dollars in the developed world versus in the developing world. In the developing world, a lot of people use dollars as a store of value to retain their wealth, where their currencies could hyperinflate or be less stable than the dollar. So it's no surprise stablecoins have really taken off in the developing world as an easy access to store your wealth. But in the developed world, we really don't have that problem. And dollars are used more as a medium of exchange to buy things, and store of wealth are investments, really. So if you facilitate the use of stablecoins as a medium of exchange, I think it can finally help unlock a lot of use cases in DeFi, where people would be able to earn their salaries on a block-by-block basis rather than wait 2 weeks and spend those salaries near real time as it gets integrated into services like Apple Pay and other applications. So I think we're poised to see a much more a better unison of the DeFi and real world economies that will allow lending protocols and stablecoins as well to thrive because of this. To conclude, DeFi lending's protocols have experienced a resurgence over the past year and a half. They're more battle tested than ever, more resilient, less hacks. Protocols have been experimenting and specializing. The industries in a much more solid space, and risks are also lower. So it's a very solid footing for the industry to continue to grow. And real world integrations are expected to continue accelerating, really helping take this to an order of magnitude larger over the next few years, or at least so we hope, and we're working towards that. Thanks everyone for tuning in. The next webinar will be about a completely separate topic. It will be about Bitcoin, the rise of BTC yields. We'll be talking about staking, restaking, and layer 2s on top of Bitcoin, which for the first time are creating yields on top of Bitcoin, something that wasn't possible before, or at least not in a native manner. So we'll be talking about that. It's a huge ecosystem that's growing very quickly. So make sure to sign up now to the link in our chat, and I'll be sticking around for questions for a few minutes. Okay, I see a question here from Isa. Would using reputation as collateral in DeFi not require a central authority to coordinate this? It's a good question. Let me go back to that slide. Okay. So yes and no. There are some services like the Coinbase one that are a little more centralized, where essentially Coinbase is a central party validating that you have this address and that reputation tied to it. A little more decentralized approach is CKTLS, which essentially plugs into existing public APIs without the central parties even needing to approve it. So it's somewhat permissionless. We'll see if it scales, if it continues that way. I can see it creating some friction. But essentially, it allows to verify in a zero knowledge way, where the user has, say, oh, you want to issue loans only against people that have 100K followers. I know it sounds like an obscure case, but bear with me for a minute. So if you have 100K followers and you verify that those are real, you can validate that you're worthy of a loan. And if you don't repay your loan, your account gets temporarily blocked. So you rely on a centralized API, but you do so in a way that's validated permissionlessly, rather than having, Twitter specifically say like, oh, approve this loan. So it's like plugging in public infrastructure from the Web2 services, like Twitter as this example, and making them accessible with Web3. That might not be the way it pans out, but it will allow to a lot more integration of Web2 identities with Web3 DeFi. See a few thank yous and familiar faces. Thanks everyone for sticking around. A few questions more. Is it possible to use tokenized real estate as collateral on DeFi lending platforms, or are they not ready yet? So essentially, no, at the moment. Real estate has shown a lot of challenges being tokenized, partly because it's a heavily regulated industry. There's some websites that have allowed tokenization of real estate, and essentially these are NFTs because each property is different than another. It's not fungible. Therefore, that also creates lack of liquidity for these assets. So NFT lending and borrowing has had challenges. I think doesn't scale too much, and real estate faces the challenges of being over-regulated and also non-fungible. So if you were to liquidate real estate NFT, it's unclear how that would really transpire. Therefore, it's seen a lot of challenges in that integration. I think first we'll integrate like the more fungible real world assets like stocks and treasuries. Well, for that matter, we already see treasuries integrated in DeFi. And then, probably in 5 years or more, we'll start seeing real estate integrated in DeFi. I see a few other comments on the SEC and a couple other things. One more question, and I think we'll be done. Okay, so last one. If a successful under-collateralization solution for DeFi protocols is created and stablecoins are integrated with Apple Pay, etc., won't this make it difficult for central banks to predict the money supply in the market, resulting in monetary policy not working properly? It's a good question. I think, we're still very far from DeFi being a problem for monetary policy. At the end of the day, you have to think of the role that stablecoins play in monetary policy. And I would argue it actually facilitates it in many ways, because stablecoins are increasingly providing capital for the government to borrow against. So that could be, in a way, benefiting central banks, and you would be able to, let's say, if a lot of people are borrowing stable coins, that creates more demand to mint stable coins. And if you see it in like a large enough scale where stable coins reach the trillions, it essentially creates more oversight for the central bank to track cash flows into bonds. So I would argue it actually benefits it. I'm, thinking about this deeply for the first time, but seeing how each of the pieces work, you could see a future where the central bank is looking at what's being borrowed in stable coins on chain, be that in Aave or some centralized lending, alternatives. And you would be able to forecast a bit more clearly those flows of capital, since you can see them on a real-time basis instead of, at the end of each business day, or in some cases even quarterly when entities report. So it would create, a lot more real-time focus on the data, and it might have some challenges in adapting the central banks to having that loan demand be accessible. But over the long haul, I think it would make the monetary policy a lot more stable and predictable. So a good question to wrap it up on. Thanks everyone for tuning in. Make sure to sign up for the next webinar, and we'll be talking about Bitcoin yields. Appreciate the positive feedback, and we'll see you in the next one. Thank you.